Both General Motors and Ford are launching new models this year. According to Cathie Wood, customers who switch to electric vehicles from GM or Ford will no longer buy the EVs offered by those companies. She assumes that no one else has a choice but to purchase a Tesla vehicle. This year, Cathie Wood surprised the market by placing a wager against the two corporations. She believes that the value stocks of GM and Ford are on the verge of going bankrupt. Before we continue with the video, make sure to subscribe to Dinero Association and hit the notification bell so you don't miss anything from the latest in financial market. Cathie Wood is making a history with a huge new short position. A longtime admirer of Elon Musk's work, car industry veteran Cathie Wood is dubious about the recent resurgence of major brands like Ford and GM. Some of you may be questioning why she isn't just buying Tesla and covering her positions in Ford and GM. Shorting a stock can result in a 100% profit or a never-ending loss if the stock drops to zero. If you have a long position in a stock, you can lose all your money, but your potential gain is limitless. Due to a general market crisis, Cathie Wood has decided to take this action. This video will help you understand why Cathie is making a massive move against Ford and GM. Customer education and illustration have been excellent by Tesla and Elon Musk. That's the kind of risky, time-consuming work that goes into groundbreaking new technologies. In fact, they aren't the first to market. Tesla's transition to electric vehicles will be more complicated and expensive than Ford and General Motors. Cathie Wood's followers could face a challenging position. Some spectators think that she doesn't know what she's talking about. Despite what many people think, a tactical investment strategy is not the same as a fundamental strategy for making money in the market. To reduce the position's risk, she is advocating a tactical approach to investing. Tesla's financial woes have not yet been overcome. A robust financial gamble does not necessitate an outstanding technology stock. In contrast to Tesla's 3% drop, Ford and General Motors are up 18% and 6% respectively. As in 2021, Ford's sales are up to 137%, while Tesla's are up 50%, continuing the trend. After Ford announced plans to double electric F-150 production to 150,000 vehicles by 2023, the company's stock price hit a record high for the first time in 2 decades. The Silverado, GM's best-selling pickup, has gone electric, boosting the company's stock price. Those electric vehicle announcements were the reason for their rise, which is absolutely ridiculous. Wood went on to say that only 2% of traditional manufacturers' overall sales come from electric vehicles, with the remainder coming from gasoline-powered automobiles. Another question that sprang to her mind was, would the remaining 98% or so be on their way out? There is little evidence that supply chain concerns are responsible for the decrease in new vehicle sales and poor recovery, but rather a shift in customer demand, which offers a considerable challenge for traditional manufacturers. Ford and GM are in difficulties due to their low gross margins, which range from 10% to 20%. According to Wood, Ford and General Motors could report a surprise loss next year due to increased spending on transitioning to electric vehicles and decreased demand for the gasoline-powered vehicles. Who believes Tesla and other electric-forward automakers are better buys than traditional automakers? Do you agree with Cathie Wood? If you have not yet subscribed, please click the subscribe button to ensure that you don't miss any of our videos. Investors hail GM's latest increase in its electric car spending objective by 30% to $35 billion. When Ford announced a $30 billion investment in electric vehicles, the firm's stock price soared to record highs. Ford's credit rating has been downgraded to a junk level, and General Motors' credit rating is on the verge of trash status due to all of this spending. To finance such a large EV spending plan, both manufacturers will have to work hard to preserve a good credit rating. A significant interest rate will be required if and when these two automakers borrow money. The low gross margins of these enterprises are one reason for their poor credit ratings. Compared to Ford, GM has a gross margin of 14.5% and 10%. For example, investors frequently accuse Tesla of being unprofitable due to its 23% gross margin. Because of the migration to electric vehicles, Ford and General Motors may become quickly unprofitable if their revenues hit. From another perspective, Ford is making a name for itself in the electric vehicle industry. Ford's stodgy reputation appeared to be resurrected overnight by introducing exciting new electrified vehicles and significant financial commitments. They're hoping to take a big chunk out of the electric truck market, but they're also eyeing up the electric SUV and van markets. It anticipates electric vehicles to account for 40% of revenue by 2030. The problem with this assumption is that we don't know how much of Ford's current business will be eaten up by its plans to produce electric vehicles. The bears may question the profitability of Ford's electric vehicle lineup compared to its current ICE autos. On the other hand, bullish cold claims that Ford's early expenditures in electric trucks, SUVs, and vans might help the company gain a significant advantage over its rivals. From there, it is believed profitability will follow automatically. For the first time in Ford's phenomenon history, the company is expanding at an unprecedented rate. Increased market opportunity and risk are both parts of this strategy shift. If Ford can show investors that there is a large market for its cars and consumers are ready to switch to electric vehicles, it can considerably lessen this risk. So far, Ford has set itself apart from other venerable automakers by completely outperforming demand projections. More than 200,000 F-150 Lightning pickup truck reservations were made by the end of the year, while 27,000 Mustang Mach-E SUVs were sold in 2021. For investors, the ability to clearly identify risk and benefits comes from approaching Ford from the perspective of what it hopes to become rather than what it was. Ford has a large and well-trained staff, and the company has a long history of manufacturing and production efficiency. As a newbie to the EV sector, it has a promising medium-term trajectory in the electric pickup market. On the other hand, the company has spent the last few years wasting time and money by overpromising and under-delivering when it comes to Tesla. Tesla today is a profitable company that excels at what it does and is unafraid to expand its market share while defending its current one. Wood is making similar predictions about the value of used automobiles, in which she highlighted increased inventories as evidence that values will fall in the coming year, impacting sales of new vehicles for conventional automakers like GM and Ford. The ARK Invest exchange-traded funds, notably the flagship ARK Innovation ETF, have been through a difficult time recently. But the fund manager is sticking to her game plan, and that is what we're keeping an eye out for. As a result of Tesla and Teladoc advances, ARK's 7 ETFs returned an average of 141% in 2020, a feat that made Wood the talk of Wall Street. But she's had some trouble since. Will she be making a shocking history this year? We can only watch from afar. But Wood said in the monthly conference that one issue is that investors and analysts are too short-sighted, failing to plan at least 5 years in advance. Tell us what you think about this video by leaving a comment below. We are Dinero Association, your partner in building wealth. Don't forget to like and share.